We've assembled a panel of experts. Joining me now, we have Michael Harkins, president of Levy Harkins, noted value investor. Also, Kenneth Polcari, managing director of ICAP Corporates. He's just actually returned from a week-long trip to Italy. Also, a darn fine recipe in our making. Also with us, Dennis Hynes, chief market strategist, R.W. Pressprich & Company. All right, Michael Harkins, let's start off talking about what happened today. Well, Europe and Italy, particularly, deciding that they're not going to go ahead with their bond auction. Why? Why don't the Italians want to sell debt into this kind of market?
Because they can't. I mean, the ESFS barely managed to get off a €3 billion offering. This today, after they tried once last week. That is really a tiny amount of money for an agency you're hoping will wind up with €1 trillion. If we're having to do these in tranches of $3 billion at a time, and you have to go twice, we're going to be at this for a very long time. Also, the Italian debt has hit this, I should say, devilish number, I was about to say magical, of 6.66 at the close in London today. And that is the danger zone.
That's the yield. That's the yield on the 10-year.
In the 10-year. And that's the danger zone. Above that, companies have disintegrated. When you get to 7, you get to 17 almost the next tick.
Kenneth Polcari, you were just in Italy. You spent a week there. Do the people that you came into contact with, do they understand the consequences of the numbers involved?
I have to tell you, the conversations I had, and I had them both with people in the countryside as well as people in Rome and in Florence, about what their sense was about this impending doom in Italy. And I have to tell you, the sense from Joe Q public in Italy is not nearly as concerning as maybe we're talking about at this moment. It's either they're just not seeing it or they don't want to see it, but the sense was that they're very much at peace with kind of where Italy is at the moment. They understand that Greece has a problem. They understand that Greece needs to take some drastic measures. But I did not get a sense from anybody in Italy that they were at all concerned about the state of affairs in Italy, which I found very interesting, because here we are having this conversation, and we've been having it now for a while in this country about what's going on in Europe and specifically what's going on in Italy. And the Italians, Joe Q public, are not that concerned at the moment.
Well, Dennis Hynes, I mean, it seems odd, right? Because if you take the total amount of Italian government debt, it's about 1.6 trillion euros. And as Susanna Howard was mentioning, that is more than the debt of Ireland, Spain, Greece, Portugal combined. Beginning in January of 2012, they have maturity payments of about 20 billion euros a month, and they're still arguing over the implementation of only a 45 billion euro austerity program. Is it that they don't see the numbers, or that maybe they've got, what, a trick up their sleeve? Why would they be so sanguine about current situations?
Well, I believe they're looking through life with their rose-colored glasses, and they're not accepting what the realities are. I think really what's happened is that the recent agreement to voluntarily forgive Greek debt has made this whole crisis turn a whole new corner. And now we're looking for the weakest economies and going after them. That's what traders do. They go after the weakest economies. And now, as it turns out, as Kenny says, that things in the Italians feel fine. Okay, but the world doesn't agree with them.
Michael Harkins, Jürgen Stark, who is an executive board member of the European Central Bank, coming out today and saying, don't worry, everything will be fixed in 2 years. But Italy doesn't have 2 years, does it?
What a charming thing, a German with a sense of humor. Who's seen that before? The man has no more notion that this will be fixed in 2 years. It brings smiles to the faces of professionals. It doesn't pass the laugh test. So the worst part of this problem is that from the beginning, the authorities have thought they had time on their side. And they so clearly have never had time on their side. That's why it keeps burgeoning, and that's why it'll continue to get worse faster. And that's why the ECB is really the only boy with its thumb in the dike. Nobody else has taken effective action. And these monetary numbers are now exploding across the continent. The ECB is on the hook for 650 billion euros or so of dodgy debt.
Kenny, all right, so you were just in Italy. You say that the people there are pretty sanguine. What is the feeling about what happens next in terms of the government?
Well, listen, they clearly understand that there has to be a change. But you know what? They're very settled in the fact that they understand it has to change, but until he wants to leave, it's going to remain the same. They're not forcing him out. He's certainly not going to, from their point of view, he's certainly not going to resign on his own. And unless he dies or gets killed, he's going to be there until such time that there's a change. Now, it's funny that they accept the fact there has to be change, but they're not ready to throw him out, which I found very, very interesting.
Well, what's the feeling about the economy? How's the economy doing?
Well, you know what? It's tough. They will say they are having a tough time, but as everyone is having a tough time, they accept the fact they're having a tough time. But they also say, you know, we don't use banks here the way you use banks in the United States. We never trusted them. We certainly don't trust them now. We don't take our money and put it in banks. It's either under the mattress or they go out and buy hard assets, whether it's real estate or gold or whatever it is. So banks don't lend. You can't get a mortgage in Italy. It's very, very difficult for them to get mortgages. Banks don't give credit the way they give credit over here, which actually I'm not so sure is a bad thing because anyone could walk in any bank here, you know, 5 years ago with no job and get a mortgage. So, you know, really, they're very comfortable with it, and they understand that change has to come, and they're willing to do it when it happens. But until it happens, until he decides to leave, they're not going to force him out.
Dennis Hynes, how do we make some money based on this prognosis?
Well, what you do, as long as you don't admit there's a problem, there's no problem. Okay, but the fact of the matter is that you see that the professionals are betting against the Italian populace. So how you can make money is this, is that the markets have been trading sideways now for some time. What we've done is using Michael's 666 number from the March 2009 low to the 1373 high in the S&P futures. That's 100%. That was 106% bull market rally. Now we had the market then trade off 20% into bear market territory and almost instantaneously recovered. And now we're up 17% or 15%, I should say, off the October 4th low. What the market is anticipating is the next round, and it is coming, of quantitative easing. So QE3 is around the corner.
So things get so bad that central banks, particularly the Federal Reserve, have to step in and everyone's front-running that trade.
That is correct. In my opinion, that's the trade we're talking about. And we know, and that's what's happening here with gold, it's happening with the stock market. Now, is it logical? No, it's not. Okay, but you never fight the Fed. That was the old tenet that you learned in your first money and banking course, never fight the Fed. And now it's become an impossible thing to fight against them.
What will be the signal in your mind that people should play to the long side? Because if you take a look at the yield on the U.S. 10-year today, we're right around 2%, just a little bit below today.
The yield below 2% is more a function of fear and fright, okay, in the Eurozone. So any close below 2%, you can find the market. We're at record lows as it stands right now. So a close below 2% would certainly be anecdotal evidence, okay, that there's fear in the marketplace. We have to have the Fed come out and actually say something.
Michael Harkins, safe havens. Is there a safe haven anymore? Switzerland used to be a safe haven.
Switzerland used to be a safe haven. I think you have to be an utter lunatic to go buy a 10-year bond in the United States at a 2% yield. Now, I know I've said this in the past, but I'm sorry. The arithmetic is so punishing. If you're wrong, if interest rates go up by 1 point a year from now, you've lost almost 10% of your money, and then you have a dreadful decision to make because you've got 9 years left. Now what do? Do you take the loss or do you hang on for more?
Well, you get to kick yourself for those 9 years as well.
It's dreadful. And then look abroad to Europe. We used to always think you could keep money in Switzerland, and no, you wouldn't earn any interest on it. It was dull. But at least you could have sort of comeback capital. It is stunning what's going on in the Swiss monetary numbers right now. This is the latest issue of Grant's Interest Rate Observer. And the Swiss National Bank has printed money at a 34% rate over the last 12 months and a 375% annual rate over the last 3.
What happened to the gnomes of Zurich?
The gnomes have gone nuts. They've simply lost their usual characterization of sound, prudent people. This cannot be seen as prudent, and certainly not permanent, lasting. This is wildly unstable.
So, Dennis Hynes, what do you do with the money? Did you just go and put it into an index fund and wait for the Central Bank of the United States, the Federal Reserve, to come in and pump money in?
You do that. I think what you'll do is that you observe right now the S&P, which is the one market that we use as the indicator of U.S. markets. The S&P is trading between its 50-day moving average and its 200-day moving average. S&P futures are currently, the 200-day moving average level is 1262. Make no bones about it. Even though, you know, P/E ratios, according to Shiller's inflation adjusted 10-year, 19 times, which is appreciably higher than the 16 times, which means the market is fundamentally overvalued. make no mistake, if you get the market to close above 1262, please jump on, go along with it, because the Fed is facilitating the ride.
Joining us now, Sophia Kalantzakos. She's a professor of environmental studies at New York University. Sophia is also a former member of the Greek Parliament, where she served as a member of the European Affairs Committee. She's also former deputy minister at the Ministry of Employment and Social Protection. Sophia, welcome to our conversation.
Thank you for having me.
We all want to know, because you...
Can I shed some light?
We do. We want to know because you can understand exactly what they're all saying. Tell
yes,
us,
they're all posturing for the moment.
They're all posturing. So this is just political games back and forth.
Look, seriously, if it wasn't so serious, I think it would be very interesting to watch how the saga unfolds. But unfortunately, this really has people sort of at their wits' end. And the climate in Greece right now is one of tremendous insecurity among the populace. Now, politically speaking, what's happened? First, we had, I think, the move by Papandreou to ask for a referendum sent shockwaves not only throughout Greece but throughout the entire world community and the markets. So in a way, I think that was a mistake. However, it has forced the opposition.
Do you think he was? I mean, you've met him. You know him well.
I don't think he was always planning this. I think what happened is that he increasingly found that he really could not find any allies, because everybody wants to see themselves get elected. So the opposition saw that it was 8 points ahead in the polls, and unfortunately, they're still in the business as usual mode, which is not. It's not an option right now in Greece. So the problem is that this move forced the opposition, the leading opposition party, to come to terms with the reality in Greece and have to sit and accept that whoever gets elected, because eventually there will be elections and there are definitely going to be early elections, that whoever gets elected has to go through this really dark and difficult period to not only restructure, but also to salvage what's left of the country, try to create growth, try to give comfort, not to the markets, to investors, to people who've taken their money out of the country, to the whole world economy, to the Eurozone. So they know that that's not easy. It's going to take a lot of work, and the opposition has seen this. And what's happening now? They finally agreed to having a coalition government. They're working really hard. The name of the prime minister, I think, is not as much of a problem. People are sitting there focusing on that, but that's the least of the worries. I think they're going to find somebody, maybe Mr. Roumeliotis, who's at the IMF, who knows about the economy. It could be Lucas Papadimas. I think it's not going to be him, but who knows? But that's the least. The big problem with the opposition right now is that they do not want to take any seats at the cabinet, in the cabinet, which means that they want a quick election. They want to maintain the 8%, which is impossible, because you can't have your cake and eat it too when you only have bad news to give people. So I think a lot of pressure is going to be placed on Antonis Samaras, and we'll see how he does. But
now, he's the head of the opposition.
He's the head of the opposition. And, you know, he's been holding on to this rhetoric of we need to renegotiate, we need growth. Everybody believes that, of course, you need growth. The austerity measures alone, and VAT tax at 25%, and taxation again and again for the people who do pay taxes, this is not going to create growth. You have to expand the tax base. Number one, people have to stop tax evading. You have to be able to take the structural funds to which we have access to and put them in the real economy. The private sector is shrinking. The private sector is completely strangled because there's no money in the market. The banks are holding...
Michael, come in on this, because, I mean, as someone who is an investor and is charged with allocating people's capital, if you don't have the policies in place for growth, and indeed if the economy continues to contract, how many years would it be before an investor would be interested in putting their money into Greece?
This is the dreadful conundrum right there, because, look, there's no price these countries can afford that would tempt me. It's not as though they could possibly afford a 12% interest rate, and you and I go off, Ken, and we say, well, maybe yes, maybe no, and we're the investment committee. They can't pay that, and I'm not taking 6. So there's the problem. Price discovery can't happen in a circumstance like that. And I have been amazed, and I'm just dying to know. It's 25 months since this crisis started. It started in October of 2009. How is it no one's been indicted? Nobody has been called to task. They lied about the budget deficit. It was more than twice what they said it was. How do people go unindicted and walking around the streets?
Well, first of all, there's a very big conversation about what the numbers were exactly. I think I will tell you this. I was in the Ministry of Labor during the hard part, which was the global crisis. I remember watching the American banks collapsing and then being held in check. And we were very scared that people were going to lose their jobs. I was in the various meetings, and a lot of the countries went and invested in the real economy. That's when everybody got a blown-up deficit.